So chargeable gain is basically the tax we have to pay. This is the addition of our income tax. So we have different sort of tax, and one of these tax is called capital gain tax. And, capital gain tax is all about when you have a capital gain or chargeable gain, and on that amount you have to pay some tax to HMRC. This is separate from our income tax. So let's have a look on the chapter overview what you have here. So the first thing you have to remember, takes computing and the capital gain tax. Let's try to understand it a little bit more. Then you're going to see how does it actually work. So we have a exempt asset. Few assets are exempt that you have to remember. So that is car. Then we have a gift, QCD, some chattel, premium bond, and ISA. On the other hand, we have the basic, that is chargeable person, the person who is liable to pay the capital gain tax. Then chargeable disposal, when you make some disposal, that is chargeable. Chargeable asset, this is any asset, this is not exempted. Calculation is quite simple. We have to find how much is the sold price, how much is the selling value, and how much is the cost. And the difference will be our gain. And we have to make sure the gain is eligible for the tax purpose. Now also you have to see a few more things. This is a very simple calculation. That one, proceed minus disposal cost. Top of that, we have some additional rules. The first one is called connected parties. Connected parties is all about when we sell the asset to some of our close relatives, for example, brother, sister. So if this sort of transaction happened, then we have to use the market value rather than the sales value, because it is possible we give the lower price to our friends and family or to the relatives rather than the market price. For that reason, you have to consider how much was the value that time in the market. Then you have to see the spouse and civil partner. Normally, like transfer between a spouse, husband to wife, or wife to husband is exempted. Then you have a gift. So gift will be always considered as a market value less the disposal cost. On the cost, we have to consider the acquisition cost and the enhancement. So cost means how much you paid to make this accrue for this asset, or how much you paid, for example, if there any legal cost, for example, any mandatory cost. Without that, the asset cannot be accrued. So for that reason, this will be the part of the cost. Also, if we make any improvement or enhancement, for example, we had a 2-bedroom flat, now we make it 3-bedroom. So this is called enhancement because it improved the capacity of the asset. That will be the part of the cost as well. So it is possible we can have a capital gain or you can have a capital loss. Now the loss can be carried forward, and the gain have to pay the tax. The way we pay our self-assessment return, the same way we have to pay our capital gain tax. The losses, we have to see how can you offset the loss, the current year loss, and carry it forward excess. So that means, for example, if I have a 2 asset, so I sold 2 asset, A and B. So from A, for example, we have gain 10,000, and from B we have a loss 2,000. So you have a capital gain 10,000 from one asset. We have a capital loss 2,000 from another asset. So this current year loss, let's say both are from 2022. So this current year loss, first we have to minus from the current year gain. If the loss is more than the current year gain, for example, if the loss is 12,000, not 10, so 2,000 will be carried forward for the next year. This is, they are saying, current year use all, then carried forward any excess. Then balance forward use after the deduction, AEA. AEA or annual exemption amount is like our personal allowance. So from here, whatever the taxable gain we have, we are allowed to minus 12,300 per year. So per annum, we are allowed to deduct 12,300. It's like our personal allowance, so you are not liable to pay any tax if the taxable gain up to this amount. So it's very important to understand that up to this amount we don't pay any tax. And then we have the rate. The rate is 10% and 20%, depends what type of taxpayer the person is. So if the taxpayer is a basic rate taxpayer, then it is 10%. If the person is a higher rate taxpayer, then it is 20%. But remember, if there is any threshold left from the basic band, we have to use it. For example, let's say someone income is 35,000, the employment income, and the capital gain tax is 5,000. So the chargeable gain or capital gain is 5,000 and employment income, let's say 35,000. This is chargeable gain or capital gain. So now before we decide this 5,000, what rate we're going to use, 10% or 20%, I have to see, is there any remaining threshold from the basic band? So normally we know the basic band is 37,500. So the employment income is 35,000. So we have 22,500. We have basic band remaining from here. So for that reason, up to 2,500, the capital gain tax rate will be 10%, and rest of the 2,500 will be 20%. So you have to be very careful with that. In the exam, you will find the income between the basic band and the higher band. All right, let's move to the next one. The next thing we have here, that is part disposal. Now the part disposal happened when you sold something, and obviously like when you this is the connected parties anyway, direct relatives, market value, we already talk about that. Part disposal happened when you don't sold the full asset. For example, you only sell part of the asset. Let's say you have a 3 acre of land, you sold only 1 acre. So that means still we have 2 acre left. So when you buy this land, you buy 3 acre, but now you sold only 1 acre. So it's called part disposal. You're not selling the whole asset. In this case, you have to use this formula to find the cost, and you have to calculate the gain. We're going to see that in the question anyway. The another thing we have to be look at, this is called chattels. Chattels, we have a vesting chattels and we have a non-vesting chattel. So vesting chattel, if the asset life is less than 50 years, it's called vesting chattel. If the asset life is more than 50 years, it's called non-vesting chattel. Now there is some 6,000 rules. We have a table. You have to memorize that. You have to remember that, because in the exam, it will come definitely the question from the chattels. All right, let's have a look. Some question now, and we'll see how's it work. This is the template that we have to remember when we calculate the capital gain tax. First, we need to see the disposal consideration. Disposal consideration means how much we sold it for, sold, or the market value, less incidental cost of disposal. So if there are any cost of the selling, for example, the commission, advertising, any incidental cost will be taken away from here. Then we'll have a net proceed. Net proceed is actually how much we're receiving from the sale. Then a less allowable cost. Allowable cost is including the acquisition cost. Now, allowable cost is the cost when you buy the asset plus any enhancement, any sort of like legal cost, solicitor fee, surveyor fee, that is part of the cost you have to take away. And the enhancement expenditure you have to take away. And finally, the amount you have, this is called capital gain. And in this capital gain, obviously, before you pay the tax, you have 12,300. That is allowable. So you have to take away from here to find is there any remaining balance where you have to pay the tax. Let's look at one example, then hopefully you'll understand more. Okay, so let's look at activity 1. Let's have a look at this one. Capital gain tax calculation. Mr. D brought an asset for 12,700. So this is the acquisition cost in February 1986. He incurred legal fee 500. So when you buy this one, he paid 500 legal fee. So that will be the part of the cost as well. And he sold it for 38,500, incurring expense 1,500. So this could be the selling cost, the commission, could be advertising, anything. So this is the selling cost. So from 38,500, I had to pay 1,500 because I didn't receive this 1,500. So to make it sellable, 1,500 I had to pay. While he owned the asset, he improved 3,000. So there is some improvement cost as well. So let's try to find how much is the capital gain here, not the tax, just the capital gain. First, we need to see how much you sold it for. Proceed. We sold it for 38,500. After that, you have to take away any selling costs. So you have to pay 1,500 selling cost to make this asset sellable. So the net proceed we have 37,000. Then we have a cost. So you need to see how much you have cost. Acquisition cost we have 12,700. 12,700. Then we have a legal fee when you buy this one, 500. 500 is the legal fee. We have enhancement expenditure, we have a 3,000. So from 37,000, if we take away everything, my capital gain is 20,800. So that's how we can find how much is the capital gain. And once we have the capital gain, our next step will be to find how much is the tax. And as I said, before you calculate the tax, we need to see what type of taxpayer the person is. Is it a basic rate taxpayer, high rate taxpayer? We're going to see all of this. Anyway, so let's have a look at our next question and to see how to calculate the tax. So the next one we have activity 2. We have current year loss. So loss from the same year. In 2021, Ted makes a gain 45,000 and 10,000. So have a 2 gain, 45 and 10. He also make a loss of 48,000 the same year. Ted has no losses to bring forward from the earlier year. So from the last year, he don't have any profit to bring. So any profit, any loss, if he have from the last year, he can still carry it forward it, but he don't have any from the last year. Complete the following sentence. Ted net capital gain. How much is the capital gain before the annual exemption? That is 12,300. So let's try to see how much was the total gain. So we have 45. So 45,000 plus 10. So my total gain for 2021 is 55,000. 2021, 55,000. Now we have to take out the loss. So CY, current year loss, that is 48,000. So if I take it out, my net capital gain for this year is 7,000. And I don't have any loss to carry it forward because my gain is more than the loss. So the first question is state net capital gain, that is 7,000. And Ted has a loss to carry forward. We don't have any loss because our gain is 55. So it offset all the loss, 48. So we still have 7,000 gain. So we don't have any loss to carry it forward. So it will be nil. If my loss is more than the gain, so we'll have some loss that will carry forward for the next period. All right, let's move on to the next one. The next one we have here, prior year losses. So losses from the previous year. So let's have a look at that. Says Tara makes a gain on a property 2021 of 12,800. Proceed of 25,800 less cost 13. So they already give us the disposal value and the cost. So the difference is 12,800. So we already have that. She makes no other disposal in the year. So there is no more gain or disposal in this year. Tara has a loss brought forward from the previous year, 10,000. So she has some loss that will come from the last year, that is 10,000. So the question here is Tara net capital gain for 2021 before the annual exemption. So before the annual exemption, how much is the net gain? The net gain already given in the question, 12,800. So 12,800 is our net gain. 12,800. Now from 12,800 is my net gain. 12,800. And we have some previous year losses. Now this losses is not from the current year. Remember that it's from the previous year. If the loss comes from the previous year, we have an option. We will take it out after the annual exemption amount. So if I said my annual exemption amount is 12,300. So I have here 500 gain left. And I already have loss from the last year, 10,000. So if I said previous year loss, I can only take up to 500 to make it nil. And from 10,000, if I use 500 for this year, so the carried forward balance would be 9,500 for the next year. So 9,500 for the next year. Remember that this is very important line to remember. Only if the loss is for the current year, only that time we have to take away first before the annual exemption. But if the loss is from the previous year, we're going to use the annual exemption first, then the previous year loss, because the annual exemption will be wasted if I don't use it. My loss can be carried forward. It is possible the loss can be carried forward for the next year, but the annual exemption will be wasted. So if I don't use my annual exemption, it will be wasted. So you have to make sure the annual exemption can be carried forward for the next year. But if the loss is also from the current year, we don't have any choice. We have to use the current year loss from the current year gain first, then we can use the annual exemption. In this case, if we don't have enough gain, the annual exemption amount will be wasted. But if we have the loss from the previous year, we will be able to use the annual exemption amount first, and the loss will be carried forward for the next period. All right, so let's have a look. Let's move to the next one to see how to calculate the tax on that. So the first one, activity 4, it says computing capital gain tax payable. Let's calculate. Let's see how can we calculate the capital gain tax. So we have here, so Mr. D, see activity 1. So they're asking to follow the activity 1. Had a chargeable gain of 20,800 from 2021. Okay. He has a taxable income 31,000. This is very important. So you have a chargeable gain that is 20,800, and also have a taxable income that is 31,000. As I said, always remember the basic band threshold, because the basic band threshold is 37,500. Any remaining amount will be charged with the 10% capital gain tax. Okay, so here we can see his taxable income could be employment for, or could be anything, 31. So from 37,500, if he earned 31,000 from the employment or from anywhere, he left only 6,500 for the basic rate, that is 10%. So that means from 20,800, I can only take 6,500 for the basic rate. But also you have to remember, there is something from the chargeable gain we always take away, that is called AEA, annual exemption amount, 12,300. So up to this amount, we don't pay the tax anyway. So let's do some working. So my capital gain is 20,800. From here, the first thing I will do, I'll minus the annual exemption amount, because I don't have any current year loss. Maybe it's already adjusted. We are following the last activity. But if there is any current year loss, I have to take away this one first. So I'll take away the annual exemption amount. That is 12,300. And that will give us taxable gain. The gain we have to pay tax on, that is 8,500. And from here, we have to see how much tax we're going to pay on 8,500. This depends any basic band left. We already see we have a basic rate or basic band left 6,500. So from 8,500, 6,500 will be 10%, because we have this remaining band. And any additional, that is 2,000, that will be for 20% higher rate. So you need to be very careful with that. So any taxable gain come, before you say is it 10% or 20% the tax, you have to see is there any basic band left. You have to always do the calculation. And in the exam, you'll see this thing, they're not gonna make you too easy. They will give you with the mix. So 6,500 times 10%, it will give you 650. And 2,000 times 20%, it will give you 400. So 650 plus 400, it will give you 1,050. And this is your capital gain tax payable. So the question is, what is the Mr. D capital gain tax payable? The answer is 1050. So very simple, but you need some practice to do it. All right, so let's move to the next one. The next one, we have a part disposal. To do the part disposal, you have to remember this formula. So you have a value of the part disposal and A plus B. A value of the part disposal of, or market value of the remainder, value of the part disposal and the market value. So A represent the gross profit or the market value before deducting the incidental cost of the disposal. So if there are any incidental expense, will not be allowed to consider here for the part disposal question. So A will be the gross proceed, how much you sold it for, or the market value before deducting incidental cost of disposal. B is the market value of the part of the asset that is not sold. That means the remaining of the asset. How much is the value for that? So the way we calculate that, first we find the gross profit, we minus the selling cost. This is my net profit. And after that, to find the cost, we have to use this formula. So original cost of the whole asset times A divide A plus B. A represent the gross profit and B represent the value of the remaining asset. And we minus this one to find the gain. So you have to remember this formula because in the exam it will not be provided. Anywhere if you see it is written formula to learn, that means you have to remember because it will not be provided in the exam. All right, let's try one question. Let's see how's it work. So we have here, so Tom brought 10 acre of land for 20,000. So 10 acre of land, 20,000. This is the cost of the whole 10 acre. He sold 3 acre of land for 10,000. He sold 3 acre for 10,000, incurring disposal cost 950. When the remaining 7 acre or 36,000. Okay, so let's use the formula first. First, we need to know, we have to calculate, this is the gain on the disposal of the land and the cost of the remaining land carried forward. So let's try to do that. So gross profit, we sold it for 3 acre, we sold it for 10,000. So my sold price or market value 10,000. And we have some incidental cost that we are allowed to minus less disposal cost 950. So my net proceed is 9050. Net proceed is 9050. Now when you calculate the cost, we have to remember we cannot consider the incidental expense. So less cost. And with the cost, we have to follow this formula that cost times total cost times the whole asset cost times A over A plus B. So the whole asset cost was 20,000. So 20,000 is the whole asset cost times A, how much you sold it for? You sold it for 10. And A plus B, that is 10. And B is the value of the remaining assets. So remaining 7 acre value 36,000. So 36,000. And that will give us the cost. So 10 divide 46 times by 20,000. And it will give you 4,348. If you minus that, that will give us the gain. And 9050 minus 4,348 will give you 4,702. So we have now two. We have a gain on the disposal. So the gain is 4,702. And the cost of the remaining land carried forward, how much it is. So we have total 20,000, the cost. So total cost was 20,000. And from this 20,000, we take away cost, how much? 4,702 minus 4,702. And of course, the rest of the cost will be carried forward. So 20,000 minus 4,702 and 15,219 will be carried forward. 4348. The cost is, oh, sorry, it's the gain, it's not the cost. So the cost is 4348. So it will be 4348. 4702 is the gain. It's not the cost. The cost is you by using this formula, how much you come in here, that is 4348. So we said 20,000 minus 4348. This is our cost. So cost minus cost. From the total cost, if we take away the cost for 3 acre, the remaining will be our cost that will be carried forward. And that is 15,652. So 15,652. All right, it's not very difficult one anyway. So let's move to the next one, the chattels. Now, as I said, there is a box that we have to remember. This is the box we have to remember for the chattels. And rule for computing the chattel. So if the cost is less than 6,000 and the proceed is less than 6,000. So if it is both less than 6,000, so your cost is less than 6 and the sales price is less than 6, then it is wholly exempted. No need to calculate any gain, is wholly exempted. So cost less than 6 and the selling price less than 6, wholly exempted. The next one, cost less than 6 but sell more than 6. So any gain restricted to maximum of 5/3 times the gross proceed minus 6,000. This is very common in the exam. You have to remember this one especially. So cost would be less than 6 and the sales would be more than 6. So you have to use this formula to find how much is the gain. Then calculate the gain, compare to the maximum and take the lower figure. So you have to know how to do it. We'll do some question for that to understand it. Then we have cost more than 6 and the sales less than 6. In this case, you have to always consider, the gross proceed deemed to be 6,000. Even though, for example, the proceed is 4,000, the sales is 4,000, you have to still think it is 6,000 because the cost is more than 6. Then the difference will be lost. Do normal calculation, but always use 6,000 as the gross proceed figure. So any loss, you can carry it forward. Then finally, the last one, the cost is more than 6 and the sales is more than 6, wholly taxable. So there is two things very easy. The first one and the last one. The first one is if the cost is less than 6 and the sales is less than 6, then it is wholly exempted. And if the cost is more than 6 and the proceed is more than 6, is wholly taxable. So this tool will be easy to remember, but the middle two, you have to be remember to do some workings for that. All right, so let's do some exercise. Hopefully you'll understand more from there. So let's do one activity, activity 6. So we have here Orlando Gibbons purchased a rare manuscript for 500. He sold it several years later for 9,000. Okay, before deducting the auction commission 1,000. So the auction commission was 1,000 and he sold it for 9,000 and the cost was only 500. He also had an antique broth for 7,000, which he sold 2 years later for 3,000. So cost was 7. So cost was more than 6, but sales is less than 6. So let's try to do that. The first one is the chargeable gain on disposal and the loss on disposal. So let's try to see the first one, chargeable gain on disposal. So the first we need to see how much is the proceed. So proceed or sell, sold it for 9,000. Any cost relevant to that, that is the auction commission. So less the selling cost, 1,000. So actually the net proceed is 8,000. This is the money I have received by selling that. Then I have to minus the cost, acquisition cost, 500. And if you minus that, the capital gain is 7,500. Now, the next thing you have to see, as the cost is less than 6,000, because the cost was only for 500 and the sales is more than 6,000, we have to use the formula. If you remember the formula, 5/3 gross proceed minus 6,000. So the formula is 5/3 gross proceed minus 6,000. 6,000 is the base because it's a chattels. Chattels rule sometimes say it is a 6,000 rule. So you have to remember, like, the question give you any amount that is relevant to 6,000, you have to understand it's a chattel. So we have here, how much we have here. So let's have a look at, so how much we get gross proceed. We have, so 5/3 and the gross proceed is 9,000 minus 6,000. And that will give us 5,000. Now I have to see this one, the capital gain you have calculated, the normal calculation, 7,500, and with the chattel rules, 5,000. So between these two, we have to compare. We have to pick the lower one. So between these two, we have to compare and we have to pick the lower one. So between 7,500 and 5,000, the 5,000 is the lower one. So you have to take 5,000 here. So chargeable gain on disposal is 5,000. The loss on the disposal, how do you calculate that? The next one, 7,000 was the cost and 3,000 was the selling price. So cost is more than the selling price, isn't it? So even the cost is less than 6, but we have to always consider the cost is 6,000. So I'll say proceed is 7,000 and the cost, no, the proceed is 6,000. Even though you sold it for 3, but we have to consider it 6. So proceed is 6,000 and the cost brought this item, cost is 7,000. So my cost is more than the price I sold it for. So 1,000 is my loss. Do not compare with 7 and 3. The loss cannot be 4,000 because it's a chattels and all the chattels have to follow the 6,000 rules. So even though you sold it for less than 6,000, it will be still considered 6,000. So 1,000 is our allowable loss. All right, let's have a look at the next one. The next one we have is the transfer to the connected person. If a disposal by an individual is made to a connected person, the disposal is deemed to take place at the market value of the asset. It is allowable loss. If allowable loss arises on the disposal, it can only be set against the gain arising in the same or future tax year from the disposal of the same connected person. The loss can only be set off if that is still connected with the person making the loss. So let's have a look who is this connected person. For this purpose, an individual is connected with direct relatives, for example, parent, spouse, grandfather, grandparents, and the spouse. Then this is the direct relatives, brother, sister, and we have a brother, sister from the taxpayer, brother, sister, brother, sister. Then from the spouse side, maybe their children and spouse, grandchildren and spouse. So these all are your connected person. So you have to remember that from the taxpayer, who is your connected person. And that's how you have to always use the market value. So if it is a connected person, you will not allow to use the sales value. You will have to use the market value that time, because you might give the discount or charge them less for that reason. Then we have here transfer between the civil spouse or civil partner. So I think it's between like husband and wife and the spouse or civil partner. Spouse, civil partner are taxed as a two separate people. Each individual has an annual exemption amount, and allowable losses of the individual cannot set against each other. Disposal between spouse and civil partner do not give rise to chargeable gain or allowable loss. Disposal is said to be a no gain, no loss basis. The accruing spouse, civil partner take the base cost of the disposing of the spouse, civil partner. So it will be created no gain, no loss. No gain, no loss is all about, we can say something is exempted. Okay, let's try this one. It says, William sold an asset to his wife, Kate, in the current tax year of 32,000. When the market value was 45, William acquired this asset 14,000 in June. Now, William and Kate, they are husband and wife. And if it is husband and wife, there'll be no chargeable gain will be created, because it will be transferred between no gain and no loss option will be used. So it said there will be no chargeable gain, it will be nil. Between husband and wife, there will be no chargeable gain will be arise. All right, so then we have some tax planning, and I think this is the end of the chapter for our chargeable gain. Okay, chapter number 7, share disposal. Share disposal is all about like when you sell the shares. So for example, it is also possible like you can buy some share from the companies and you sold it with the gain. Now it is also come under the same principle of the gain of the capital gain, the way we did for the chattels, but obviously the shares, the rules is a little bit different than the chattels or from other capital gain tax. So let's try to look at a little bit here and try to do this some question from here as well. Share disposal. Disposal means the sales of the proceed. So we have two rules here. The first one is for the matching rules. Matching rules is like when you sell the share, you have to follow these rules. What is the rules? The first rules is same day. So for example, if I'm in 1st of January, let's say I buy 100 shares. And if I need to sell any share on 1st of January, I have to use this share first. So I cannot use the share I have from the previous month or previous week. So first I need to use any share I buy on the same day, I have to sell on the same day. It's the same day rules. So the first we have to look at is the any share I buy today. If I buy any share in the morning and if I need to sell any share in the evening, I have to use the share I buy in the morning first, then I can move to the previous week or the previous year. The next one we have next 30 days, FIFO. Next 30 days. So next 30 days, first in, first out. So after I need to say next 30 days, did I buy any share or not? Now it look like how do I know I buy any share or not in next 30 days if I'm in today? It's like kind of confusing thing. But the answer is when I say the next 30 days, for example, if my year is ending 31st of March 2022, for example, that's my year ending, and I have to submit the capital gain tax to the HMRC by 31st of January 2023. That means if I buy any share today, 31st of March, or let's say even 31st of April, May, June, I will know it here. Let's say if I buy any share 31st of April. That means I'll know it before the January 2023. So that's why even though the question said next 30 days, that means I will still know it before next 9 months. So I will know it anyway. So 31st of January is the deadline. So on that deadline, I have to do the calculations. If I buy any share after 31st of March, this is my, for example, year ending, or 5th of April is the year ending. So from that day, the next 30 days, I will know because I don't have to send the application, don't have to send the tax return on that day. I have to send it after like certain period on 31st of January the following year. So don't be confused. The next 30 days, that means like, how do I know next 30 days what will happen? Then the share pool. Share pool is all about like, except these two, same day and the next 30 day. If there any share I have already have, like I buy from the previous month, like 6 months before, 1 year before. So all the share I have on the stock, it is called share pool. So all the share on the same pool is called share pool. And we use the average basis. So average basis is all about, we added the all share, total number of share, and divide with the total number of cost, and that will give us the share per share value. This is called the average basis. So this will get it from the share pool. Then the next one we have here, bonus and the right issue. Bonus and the right issue is all about like when we give a share to our, when we receive the share from the company, because I'm existing shareholder. So if I get a bonus issue, remember that because of the bonus issue, even if we provide any bonus issue as a company, or if we receive a bonus issue, because of the bonus issue, there is no actual cost to raise. So we don't pay any money to the company because of the bonus issue. Bonus is like a free share. Bonus is like a free share. So free share means like I only receive the share, or I only issue the share, but I don't raise any cost because no one pay for that. It's a bonus. Sometimes the question will say 441, 441. So if you have a 4 share, you will get 1 share bonus. So you have to divide by 4 to find it out how many bonus share you have. The right issue is all about when you issue the share to the existing shareholder and with a little bit cheaper price. For example, let's say when the company decide to issue a share because they want to raise some capital in the market. So if they like to raise any capital from the market, what they do, they issue some share. Now before they issue the share to the market and to the new people, they try to issue the share to the existing shareholder who already have some share from the same company. The reason is the existing shareholder will maybe upset if they issue the new share to the market and try to raise the money, because they will say like, we are already owner of your company, so we want to buy the share. Why you are selling outside and bringing the new shareholder in the company? So when you issue the right issue, when the company issue the share with the right issue, they give a little bit cheaper than the market price, because the existing shareholder will get some advantage. For example, let's say if you are employee of the Tesco or Sainsbury, you receive like a staff discount 10%. So what the other people paid, you pay a little bit less than that because you are working for them. So they give some sort of offer or benefit to you. Same story, when you have right issue, you pay a little bit less. Then we get that match proceed, how much we sold it for, and the match cost, and that will give us the gain or loss. So you're going to see that from this question. Then we have the pool treatment. We have does not affect the cost and increase the cost, depends, increase number of shares. So you're going to see how does it work for the bonus and right issue. It's not a big deal. Just we need to remember, like if there is a bonus issue, there is no cost increase. If there is a right issue, the cost is increased but a little bit less. Let's have a look this one, share disposal rules. The first one is the matching rules we have. Share present a special problem when computing gain or loss on the disposal. For instance, suppose that a taxpayer buys some share in XPLC on the following date. Number of share, cost. So 5th July 1992, number of share 150, cost 195. Then 17 January 1997, number of share 100, the cost is 375. 2nd July 2020, number of share 100 and the cost is 1000. So on 15 June 2020, he sold 220 of his share for 3,300. To work out his chargeable gain, we need to be able to identify which share out of his 3 holding were actually sold. So from this one, and that one, which one he sold it for? Since one share is identical to any other, it is not possible to work this out by reference to the factual evidence. As a result, it has been necessary to devise the matching rules. This allows us to identify on a disposal which share have been sold, and so work out what was the allowance of the cost on the disposal should be. These matching rules are considered in detail below. Let's have a look how we see these rules. So the first one, acquisition on the same day, then the next 30 days, that is FIFO basis following 30 days, and from the share pool. So let's try to understand that. Let's look one example and hopefully you'll understand from there. Matching rules. Noah acquired share in ARK Limited as follows. So you have to be very careful with the date. It's very important. 2nd of August 2012, 10,000 share. 25th of April 14, 10,000 share. 17 June 2020, 1,000 share. 19 June 2020, 2,000 share. Noah sold 15,000 share in 17 June. So you can see here, we sold it for 17 June. And we need to follow 3 rules. Number 1, same day. And the next or following 30 days on FIFO basis, first in, first out basis. Because it is possible in the next 30 days, we buy few times. So you have to follow the FIFO basis for that. And number 3 from the share pool. Share pool. Okay, let's have a look at that. Noah will match his disposal 15,000 share on 17 June as follow. The first one on the same day, 1,000 share both on 17 June. So you can see here this one. 17 June we buy 1,000 shares. Out of 15,000 we have 1,000 same day. The next 30 days on FIFO basis from 17 June to 19 June, that is next 30 days, within next 30 days. So we will take this one, next 30 days, we take 2,000 share. So 2,000 share, that is next 30 days, FIFO basis. And we still need some share because we have 1 plus 2, we have 3,000. So we still need 12,000. This 12,000 will be on from the share pool. So anything that is not with the same day and not within next 30 days will be share pool. So that means 10 plus 10, this 20,000 share on the share pool. So we'll say 20,000 share on the share pool. So from 20,000 we'll take 12 because we need to sell 15. So we take 1,000 from the same day, 2,000 from the next 30 day on FIFO basis, and another 12,000 from this 20,000. Now this one from the share pool, the cost can be easily calculated, divided by the number of share. Basic computation, how we do that? We say how much you sold it for, proportion of proceed, and the less cost from the pool. So we have this one, minus we find the gain for that, and the share pool, obviously anything will be remaining that will be brought forward. So share brought and sold, number of share, and the cost. So for example, if I have if my total number of share is 20,000, and if I buy this 20,000 share for 20,000 pound, so if we divide with that, a part share will give me £1. Anyway, let's do a question. Hopefully we'll be more clear from there. But for the time being, just remember this matching rules, same day, next 30 day, and the share pool. So let's do this question, the share pool. Jackie brought 10,000 share in X PLC for 6,000 in August 1996. Another 10,000 share for 9,000 in December 2008. He sold 12,000 share for 24,000 in August 2020. Okay, so I don't see any same day I have, that is August. I don't see any next 30 days, so only the share pool. So share pool, I have how many share? I have 10,000 share for 6,000. So 10,000 share, I buy it for 6,000, and I have 10,000 for 9,000. So this is my total share pool, and I sold it 12,000 share for 24,000. So that's fine, that's not a problem. So I sold it for 24,000 for 12,000 share. That's my proceed. And how much is the cost? This one I need to work out. So remember, there is no share from the same day here. There is no share from the next 30 days. So we straight away going to the share pool. So you have August 1996. We purchased 10,000 share for 6,000. So 10,000 for 6,000. Then another 10,000 we buy for 9,000. So total 20,000 share I have. The cost is 15,000. And I like to know how much is per share. So it's very simple. The cost is 15,000. And per share is 20,000. So 15,000 is the total cost for the 20,000 share. If we divide, that will give me per share cost. And if we multiply with the 12,000, that will give us how much is the cost for the 12,000. So that will give me how much? 9,000. It's a very simple calculation. Total cost 15, and total share 20,000. So how much is the cost for 12,000? So 15 divide 20, it gives me per share cost times by 12. It gives me the cost for the 12 is 9,000. If you minus the 9,000, we have a chargeable gain, that is 15,000. All right, so let's do one question. Let's do one activity from here. Let's do activity 1. Mr. L made the following purchase of the ordinary share in HPLC. Okay, so we have 15th of May, that is 2,200 share. The cost is 8,800. Okay, then we have 17th of May, 400 share, 3,000, and 17th of May, 500, 4,500. On May 1st May 2020, Mr. L sold 1,600 share for 14,000. The question here is, what is the chargeable gain or loss on disposal? Clearly show the balance of the share to be carried forward. Two questions. One is how much is the gain or loss? How much is the balance will be carried forward? Because we didn't sold all the share, we sold only 1,600. So remaining share will be carried forward. All right, so I'll give you 5 minutes to do some workings. And after that, we'll do it together. So I'll give you 5 minutes, do some workings on your paper. And after that, we'll solve it together. Then you can check, is it match or not? All right, so the first one we have to do, obviously, like first we need to know what is the matching rules. So that we need to solve 1,600 share. So we need to 1,600 share we have to find from where you're going to sell. The first one from the first day, like same day, 1st of May, we are selling. So on the 1st of May, we have some share that we buy. So 1st of May, that is the same day, 1st of May, same day rules. So on the same day, we have 400 share. So out of 16, 400 we have from the same day. The next one is the next 30 days on the FIFO basis. Next 30 days on the FIFO basis. So next 30 days or following 30 days on the FIFO basis. And we have on 17th of May, we can see 500 we have for the next 30 days. So we have 500 here. So 4 and 5, we have 900. And we need total 1,600. So we still need another 700, and this 700 we're going to use from the share pool. So this 700 we'll get from the share pool. Okay, now let's try to do some workings for that. The first one, we go for the same day rules. So let's have a look the same day. What happened to the same day? Same day rules. Same day rules, we need to see how much we make the cost and how much is the proceed for. So same day we can see on 1st of May, that is 400, and the cost is 3,000. So how much you sold it for? You to see that. So 1,600 data share is total. So 400 divide 1,600 and times by 14,000, because 14,000 is the total selling price for 16,000 unit. So 40,000, and that will give us the selling value for 400 share. So if I sold 1,600 share for 14,000 pound, that means I need to know how much I sold it for individually. So for the same day 400 share, the selling value is how much you need to say that. So we need to say this one, the value is 3,500 for 400 shares. And the cost was for this 400 share was 3,000. So the cost for this 400 share was 3,000. So easily we can see we make 500 pound gain from here, from the same day. 500 gain from the same day. This is the first one. The next one we have to see the next 30 days. So let's do it here. Next 30 days. What did you do with the next 30 days? So next 30 days, we do the same story. We have 500 shares. So 500 divide 1,600 times by 14,000. So this will give us the selling value. So proceed. And that will give us 4,375. And the cost was for that 500 share, it was 4,500. So less the cost 4,500. And if we minus that, the difference we have 125. And this is my loss. It's not a gain, it's a loss. And finally, the last one we have to see from the share pool. From the share pool, we need 700 share. So we have to do that. So we said for the share pool, we need 700 share. 700 divide 1,600 times by 14,000. It will give the selling value. Share pool, that is 6,125. And the cost. Now I have to calculate the cost. The other two we have a cost, but this one, the share pool, we don't have a cost. So you need to see how many shares we have in the share pool. But it's very easy because we have only one share on the share pool, 2,200, and the cost is 8,800. But it is possible you can have more than one share of the share pool. But all you have to do, you have to add all the share, divide with the cost, and it will give you the cost per share. It's very simple as this. So on the share pool, we have 2,200 share, and the cost is 8,800. So 8,800 is the cost. Divide 2,200 is my total number of share, and we times by for how many share? For 700. So let's do that. 8,800 divide 2,200 times by 700 share we taking from the share pool, and that will give us 2,800 pound. We minus that, 6,125 minus 2,800, and that will give us a gain 3,325. Now if you see that the first one on the same day rules, I have again 500. So I said 500. The next one I have a loss 125. So minus the loss 125, plus we have again from the matching rules, that was for the share pool, that is 3,325. So 3,325, and it will give us total how much? So 3,325 plus 500 and minus 125, and that will give us 3,700 is the net gain. So the net gain is 3,700. Now how many shares still you need to carry forward is very simple. So we have a total number of share from the from the 2200 share, from this is gone, the first one is gone, second one is gone. From the 2200 share we have from the share pool, and we sold it 700 share. So how many share we have left? 2200 minus 700, and then 1500 share left from there. 1500 share left from there. And how much is the cost? Very simple. So this cost was 8,800, the total cost. And if you minus 2,800, that we take away 2,800. So 8,800, 8800 minus 2,800, that will give us 6,000. 6,000 is the balance will be carried forward for the cost for 1,500 share. That's how we can do actually all this share matching calculation. All right, so let's move to the next one. Let's have a look. What is the next one we have here? The next one we have again the share pool activity 2. I'll leave this one for your homework, activity 2. It's the same thing. Let's move to the next one. We want to do some question from the bonus. So bonus and the right issue. As we discussed before, because of the bonus, there is no actual movement of the cost. And the right issue will give you some cost, but that will be less than the market value. So let's try this question, and then we'll talk if you have any question. Okay, let's try this one, activity 3, bonus and the right issue. Richard had the following transaction in SPLC. 1st of October 1995, he purchased 10,000 shares for £15,000. So 1st of October 1995, purchase of 10,000 shares for £15,000. Then 1st of September, 2,000 shares for £5,000. 1st of February, took right issue 142 at 2.75 per share. So that means if the person have 2 shares, he will get 1 right issue. So you need to know by this date how many shares we have. So if we have like 10,000 shares, so 5,000 will be the right issue. On 5th of September 2005, so we have 2 for 1 bonus issue. So we need to see on that day how many shares we have total. We have to divide by 2 to find how much is the bonus issue. On 14th of October, sold 15,000 shares for 15,000. So actually we need to see, we sold it 15,000 shares for £15,000. How much is the gain we make? This is the main thing we have to see from here. Okay, let's do some workings from there and try to do this question together. So our main question here is find the gain or loss of this 15,000 shares. So we sold it 15,000 shares for £15,000. So we said proceed is £15,000. And we like to know, did we make a gain or loss for that? This is less the cost. For all the costs, for the cost, you have to do all the workings. So let's do some workings to find it out. So we need to know the number, the share number, and the cost. So let's do that. So first we start with 1st of October 1995. So 1st October 95, we have purchased 10,000 shares and the cost was 15,000. 10,000 shares, 15,000. Then the next one we have on 11th of September, we have acquisition. And the acquisition we have here 2,000 shares for 5,000. So 11th of September 1999, we have purchased 2,000 shares and the cost is 5,000 for that. And then we need to see how much is the total share. So we have now 12,000 shares and the value is 15 plus 5, 20,000. Then on 1st of February, we took a right issue. So 1st of February 20, we did right issues. We did right issues. What is the right issues we did? The right issue we did is 2 for 1. Sorry, 1 for 2. So if we have a 2, will give you 1. So we need to see how many shares we have on before that day. So by this day we can see have 12,000 shares. So 12,000 divided by 2. So we need to see how many right issues here. 12,000 divided by 2, not 6, sorry. So it will be 12,000 divided by 2. We have 6,000 share. 6,000 is a right issue share. So right issue share is 6,000, and they said per share is 2.75. So if you multiply 2.75 per share, how much it is? So let's do that. So we have a 6,000 share times 2.75, that is 16,500. 16,500. So we said the total right issue share will be 6,000 and the value is 16,500. So if you added this to 6 plus 12 is 18,000. And the total of here 20 plus 16 is 36,500. Then we have 5th of September, we have a bonus issue. 5th of September 2005, we have a bonus issue. The question said the bonus will be given 2 for 1. So if you have a 1 share, will give you 2 bonus. So 2 for 1. If you have a 1, I'll give you 2. So total we have 18,000 share now. So for 18,000 share, how much will be the bonus share? For 1, you'll get 2. So that means for 18,000, you'll get 36,000 times by 2. Because for every share, you'll get 2 free share bonus. So how much will be the bonus share? 36,000 share. And remember, as we said, for the bonus share, there will be no actual money is coming or going because bonus is a free share. So if you give the bonus share, obviously there is no money coming to the business. So if you receive the bonus share, it just share number will be increasing, the cost remains same. So number of share is same, increasing, but the cost is same. So total number of share now 18,000 plus 36,000, it is 54,000 total share now, and the cost remains same, 36,500. This is our share, total share so far. Now we need to know how much is the cost. So cost for 54,000 share is 36,500. So I said 36,500 is the cost for how many share? 54,000. If we divide, that will give you per share, and you have to multiply how many share we are selling. We are selling 15,000 share. So you have to multiply by 15,000. And that will give me the cost for 15,000 shares. So let's do that. 36,500 divide 54,000 times by 15,000. And that gives you 10138.88, but you can take 39. So 10139 for 15,000 share. So you can see easily for 15,000 share, the cost is 10,139. So if we sold it 15,000 share, how many share we have left? We have 39,000 share left. And the cost for that is 26,361 remaining, this minus this. So we now can less the cost for 15,000 shares. So 15,000 share, the cost to us 10,139. And that will tell us how much is the gain. So the gain is 4861. This is the gain. So this question normally is a very common in the exam. Remember that this bonus in the right issue. This question will be definitely in the exam. This will be your last question in the exam. And if this is your last question in the exam, that means like this one will give you like 10 marks roughly. So you need to make sure like you understand how to do the bonus and the right issue. If you practice few times, one question will be absolutely fine. All right, let's have a look. Is there anything else we have? And I think this is the end of the chapter number 7, share disposal.